Okay, wonderful. So thank you all for joining us. So we are talking about what is impact investing and why is it important. So first off, I just want to remind everybody to please stay on mute until we conclude both presentations. We're highly encouraging participation, so please post questions, comments, concerns, all of the above in the chat, and we'll have time for discussion after our presentations. So thank you for having me. My name is Andrea Garcia. I am the company creation specialist for the New Mexico Startup Factory. At the New Mexico Startup Factory, what we do is we help entrepreneurs and scientists take their technologies out of the lab and create investable companies. So what I'll do is I'll put my email in the chat. If anybody else wants to talk a little bit more about what we do, please feel free to shoot me an email after the panel. Okay, so our first presentation is going to be from Melanie Dubin, and Melanie is a sustainability leader with more than 10 years experience launching sustainability programs in real estate and asset management. She engages cross-functional stakeholders to build buy-in on sustainability goals and strategies, distills the wild west of corporate sustainability reporting into decision useful data, and navigates the rapidly evolving ESG landscape. As ESG analyst for Avalon Trust, Melanie integrates sustainability and ESG data with fundamental analysis, informing investment decisions across asset classes. She also shapes corporate governance through aligning proxy voting guidelines with ESG best practices. Melanie holds an SASB Fundamentals of Sustainability Accounting credential and is an LEED accredited professional. She holds an MBA in finance from the University of New Mexico, a master's degree in strategic leadership towards sustainability from the, and I'm gonna butcher this name and I'm sorry, Blekinge Institute of Technology in Sweden, and a bachelor's of science in Spanish from Penn State University. Now, I don't know about all of you, but since COVID hit, I am constantly on Zoom. So we decided we're gonna have a little fun with this, and I'm gonna go into game show host and say, go Melanie.
Thank you so much, Andrea. Really excited to see all of these faces here today, and bear with me, I'm gonna share my screen. And let's see, share screen 2. There we go. Can you guys see ESG investing slides?
We sure can.
Thank you. So I know, just based on quickly scanning some of the comments in the chat box, which are awesome, thank you, keep them coming, that folks might be more involved in indirect or off-market, not necessarily public equity investing, which is the space that I operate in at the moment. But I think it might be helpful and maybe useful, especially for folks in the finance program at UNM who are students, just to see how one could look at public equities, even if you don't invest professionally. If you have a 401k or a 403b, retirement plans, there might be some nuggets in here for you. And so what I'd like to do is just share the lay of the land through the impact in ESG investing world, through the lens of an ESG equity analyst. And ESG is environment, social, and governance. It's kind of the jargon for sustainability in the investing landscape. And then how I navigate this wild west of investing and make as informed choices as possible. So a clear-eyed look at the current reality, because it's always good to start with where we're at, is that environmental, social, and leadership or governance issues that were once revolutionary or fringe are now really commonly accepted. And I'm not going to be getting into all of these bullet point issues here because they each really deserve careful attention and dialogue. But the point is that in the past 12 months, issues of structural inequality, climate change, the importance of skilled leadership in particular, have become much more clear to many more people in a way that we really haven't seen in the past. And when it comes to companies, so bringing it down from the broad wide world to specific individual corporations, all the different stakeholders, whether it's employees, community members, investors, customers, are all armed with much more information. So there's much less gray area for companies to hide behind. Now, as an impact investor, or somebody interested in having a positive impact with the public equity space, what on earth do you focus on? Because there's a barrage of information. So I like to draw some boundaries around impact that help me focus on what's most important, relevant material. As an equity ESG analyst, I think about impact first and foremost at the core business level. The activities that drive revenue usually have the biggest impact out in the world. And if we ignore them, then we risk ignoring the impact of the core economic activity around the world. And by focusing on core products and services, you're also focusing on the stuff that management will take seriously because it pays their paychecks. Separately, I like to think about the company's operations. Are they good corporate citizens, and all of the different details that comprise that question? So relationships with stakeholders, are they union busting, or what's the median pay relative to top earners? Are there major lawsuits? Are there spills or leaks, unmitigated emissions? Are controversies one-off or systematic over time? There's no perfect corporate citizen, and there's no perfect company, and most companies are not purely good or evil, but putting together like a systems perspective of how they operate is a good indicator of their corporate citizenship. And then, of course, we think about the supply chain, how fragile it is, as we're seeing play out with this boat stuck in the Suez Canal, and how destructive the supply chain might be, or how they're leveraging, how a company might leverage its power to affect positive change up and down the supply chain. And then, of course, there is something that I think gets lost sometimes, but I've come to focus on it quite a bit, which is a company's influence over policy and elected officials. And so how are they using their soft power, their dollars, through either direct campaign finance or industry associations to influence policymakers? That's really important, and it's really opaque. It's difficult to figure out, but to the extent that we can find data on how a company impacts decision makers who are elected officials, I think that's really important, because what they could be lobbying for behind closed doors, like with cigars and brandy, although I guess it's on Zoom now, but what they advocate for behind closed doors could directly contradict what they publicly claim or state or make goals towards. So that's an area of increased interest for me and for a lot of other ESG investors. And then on the other side, there's like outside of the company itself, there are shareholders, which are one set of stakeholders. And shareholders have a really important opportunity to vote on proposals that come from company management and that also come from other shareholders. And so a lot of the proposals that are coming up now are around transparency on political spending, on transparency around how far you are along in achieving your publicly stated climate goals, et cetera. So broadly speaking, this is how I think about impact in the public equity space: core products and services, operational sustainability, political influence, other stakeholders like suppliers, and then externally the shareholders who vote on initiatives to advocate for a particular outcome. So stepping back broadly, data has shown for a while now that on the whole, ESG companies that have higher ESG scores, as determined by research providers, perform better over time. And these are various ESG indexes relative to the blue line benchmark. That is the MSCI All Country World Index. And so this gray one is the MSCI SRI Index. So my goal in this presentation isn't to prove that sustainability pays off, but rather just to highlight one of the many credible data sets that are out there that show good corporate citizens and companies that make products that address our complex, dynamic, interconnected world tend to perform better over time. And that's correlation and causation, but it is highly correlated to the rapid inflow of assets into sustainably labeled funds. So the outperformance of ESG funds coupled with the huge inflow into funds labeled in some way as sustainable has given a really big incentive to companies to be in the sustainability benchmarks, to get good ESG ratings by the different ratings providers. They're kind of like a Fitch or a Moody's or some providing a credit rating. There's organizations that rate listed equities for their ESG performance. And yet, as you've probably experienced, it's impossible almost to find a clear and useful definition of what a sustainable fund is, what is an impact fund, really. The definitions are all over the place. And just to quickly dispel a common myth that ESG outperforms because it's heavily weighted towards tech companies, like an ESG fund would have mostly the FANG stocks, because they're rated higher than like an oil stock. That's not the case. The fundamental outperformance tends to be rooted in fundamental ESG metrics, not sector. There's not, the attribution isn't because of a sector or other factors. So I just wanted to stick this in there. And so here's where we are. Assets are flowing into ESG funds and impact funds and all other kinds of labels, green or other. But the challenge is really difficult once you dig into what's actually in those funds. And the reason is listed companies are required to provide audited financial statements with the same metrics year over year. And we learn that in accounting class, and we as fundamental analysts often look at cash flow statements and balance sheets. The data is easy to find, easy to compare across companies and within the same company over time. So you get useful data that you can use to make decisions. With sustainability data, no such requirements exist. And so there's a big information asymmetry between companies and investors when it comes to sustainability data. Companies can tell whatever story they like. They can pick one framework, one voluntary framework to report in one year, and then pick a different one the next year, whatever's popular in the, whatever the zeitgeist is, you know, they can talk about that and put up all the buzzwords, but sustainability reports are not like financial reports. They're not decision useful per se. And so I'd like to just highlight an ideal situation for corporate reporting. So on the left, little red house, there are financial reporting guidelines that companies can use and sustainability standards that companies can use that are right now voluntary, but that require companies to report on financially material sustainability data that contributes to a broader understanding of a company's ability to create value over the long term. And then there's the broader sustainability reporting standards like GRI, which companies typically use to report sustainability data, but it's not in a way that is as efficient to analyze as a financial report. And so ideally, the financial reporting would include relevant, specific, measurable, comparable, reliable sustainability data. And I'll focus specifically on this organization called SASB. It stands for Sustainability Accounting Standards Board. And I really like SASB because they've created a great process for companies to figure out what is relevant for them to report on that is not financial, but sustainability data. And a huge number of companies, numbering in the hundreds now, use the SASB standards. And then there's all these NGOs here in the middle row: Carbon Disclosure Project, Climate Disclosure Standards Board, GRI. So there's these groups of NGOs have kind of bound together to influence SEC and IFRS, and they're gaining traction in the financial reporting world for how companies might be eventually someday required to report on ESG metrics. And then broadly in the regulatory landscape, material sustainability data is gaining more traction, in large part thanks to these NGOs, but in particular, the SEC, and I'm just going to read, bear with me a second. I'm just going to read a statement from the acting chair of the SEC. Last Monday, she gave a speech, and it really threw me in a positive direction. It was shockingly wonderful and something very unexpected. She gave a speech about climate change, inequality, and the SEC's role in addressing these complex interconnected challenges. So I'm just going to read a quick quote here. This last year has helped to clarify why the perceived barrier between social value and market value is breaking down. COVID has driven focus on worker safety. Protests in the wake of the senseless killings of George Floyd and others have driven focus on racial justice. In both of these narratives, we can also see connections to climate risk. With COVID, we saw supply chain disruptions similar to that which climate events can cause. We know climate presents heightened risk for marginalized communities, linking it to racial justice concerns. We saw in real time that the issues dominating our national conversation were the same as those dominating decision-making in the boardroom. And then just one more quote here. To further inform our policymaking, today I am issuing a statement requesting public comment on climate disclosure. Of course, we already have an extensive public record, et cetera, but it's time to move from the question of if to the more difficult question of how we obtain disclosure on climate. So just getting back to the concept of impact, there's a lot of ways that companies have impact. There's a lot of ways that investors can have impact. And the main point I'd like to leave you with is that we can advocate companies to be more transparent, to report on sustainability issues that affect their stakeholders through proxy voting. So even if you have just a retirement account, should we be so lucky to even have one of those now, you can vote and have a say on these important decisions, and those votes matter. I'll just cite a quick example that shareholders have been pressuring Exxon, the oil and gas major, to address climate risk, and they've pushed back for decades, even though they knew, of course, internally that it was a risk. And finally, after enough pressure, they not only agreed to publish a report on climate risk and how their business is going to be vulnerable to it, physical risk of climate change and the transition risks from the regulatory perspective, but they also, investors who voted proxies and pressured the company also got a climate expert onto the board of directors, which is huge. That's almost not happened. I don't think that's happened before in the climate space. So leveraging your shares in mutual funds or individual companies, even just from your retirement, is one way you can have impact. And the other way is really, I think, just paying attention to individual companies, focusing on their core product and service, and that will help you tune out the noise and focus on the signal. What kind of business model do they have, and will it last into the future where there's a lot of uncertainty, and yet a future in which there's equity and justice and a climate for us all and our future generations. So I'm going to stop there and check in with the chat because I haven't read it while I was presenting. Looks like I don't see any specific questions. Does anybody have any specific questions that I might help answer?
I have a quick question about, you were saying that these sustainability focused companies are outperforming others historically. Do you think that's an outcome of the business model just being better, or more people are willing to put the capital into the companies that have a sustainability focus, therefore driving up the performance?
It's a really awesome question, and it's one that a lot of people have brought up in the kind of analytical world. So you're thinking in the right way. And MSCI just published a white paper about the increase in value. Like, is it a bubble, effectively, was the question they were asking. Is the huge inflow of capital into sustainability funds driving up the underlying equities in those, driving up the share price? And they did a whole bunch of attribution analysis to determine that, in fact, it's not a bubble. And I'm happy to share that research. It's a whole presentation in and of itself, but I would love to have the organizers of this event like broadcast that research. I can send it to them because it's good research, and I think it's important to really examine attribution when we're making claims. They've isolated ESG factors, and they did kind of like factor attribution, and the research, the bottom line is that they really believe that it's the specific ESG factors that drove outperformance, rather than what some people might say are similar, the quality factor or value or what have you. But those are the kind of things we have to be careful and really like ask ourselves tough questions about.
Perfect, thank you.
Does anybody have any other questions right now? Go ahead.
Yes, Miss Melanie, there are some experiments that are related with something called the donuts economic model, that is like a balance between the economic growth with the take care of the environment. So I wonder if an investor wants to look something like that type of platform here in New Mexico, where we are going to green and all these things as a possibility in the future. How do you think it would be the best way to measure that type of impact? How the interest of something like that could happen here locally? Because like when you were talking about how that could impact, just from my standpoint, you know, the public relationships as an item directly in the sustainability report, or how good doing something that is going to be in the benefit of so many will be so that by itself will that public relations will help the part of or diverse population, the understanding, because like you were mentioning in the report about the people of color that are most affected, that is PR. So that has an impact and a way to see it. But how you will measure it in terms of the discussion that we are having, because all of these, many of these things look intangible. It's like how we cash this here and being able to put it, and that people who just play with specific numbers in dollars and not see it in other aspects can make it happen and see that as a value. I'm sorry for my long answer.
No, it's fine. I appreciate it. It's very thoughtful. And it's an important question. I really think, like, number one, we have to get political a little bit and advocate for regulation on what companies disclose, because transparency is, none of this matters if we're not getting the real data and the real information that is accurate. So in whatever, using whatever influence you have in the circles you're in to advocate for transparent corporate reporting, that's the first thing. That might not speak directly to local in New Mexico, but there are enough companies in New Mexico that you could engage with them directly, because they're typically smaller and you might have more access to investor relations on the publicly traded side. Drew will talk about the less public traded side and the more informal and indirect investing and how you might exercise influence there. Yeah, and the other thing I think is, for whatever kind of company, the Sustainability Accounting Standards Board has come up with metrics that tie in sustainability and value. They've like operationalized sustainability issues so that companies can start to measure the right things, because you can't change what you don't measure, to use this trope, but it really does matter what you measure. And so getting companies to measure the right metrics, I think, is important also. Looks like Steffi has a question.
I've noticed that funds that are covering bonds are a little slower to get emerging. Why is that?
There's a couple of reasons. It is very slowly. It is slower, excuse me. It's less mature. And yet there's this whole green bond world where you can get your credit issued as, or certified as, a green bond if the activity that the cash flow would be generating meets certain criteria. But again, there's like not a regulated set of standards. And so people are just doing it wherever, and some companies issue, some quote unsustainable companies issue green bonds if the specific project that money would be funding contributes to a sustainable activity. And so you have to, it's like really the devil's in the details, like anything. But I don't really have a good answer for that.
It just seems that, like in New Mexico, we want wind farms, we want solar farms, we want storage, and we have so many banks that are funding, fossil fuel projects that they shouldn't be. So it seems like such a niche place to do a lot of good that isn't being developed as fast as it might be.
Yeah, I think it's like the path of least resistance, perhaps. There's a steady flow, like the whole infrastructure is set up to get capital to existing kinds of projects. And so folks like Drew and others, and there's just, you have to kind of like activate an entirely new ecosystem of information and actors and participants, and to get capital flowing in a different direction, and that's an important endeavor. But yeah, it's a good observation.
Okay, anybody else have any questions or comments?
Looks like Abby's hand is up.
Please go, Abby.
Stephanie, as per usual, your points are really good and interesting. I kind of want to harp a little bit on just kind of like institutional investing as well, because banks have such a huge impact on communities, and you do see a lot of these larger institutions investing in things that they know, because, you know, investing in a huge wind farm project versus an oil field, like, we have a lot more data on that. So a lot of larger institutions that are a little more risk adverse, they don't want to change or, you know, invest in things that they aren't sure about and they aren't entirely comfortable with. And so how do we, you know, it seems like with this data, like why isn't everything just ESG? Like, because like obviously all of those companies are doing fantastic. So like, why don't the larger institutional investors get it, and how do we get that across to them? I guess.
And my answer is yes. I think number one, when it comes down to brass tacks, sometimes doing the right thing is not going to be immediately good for the long term. I mean, immediately good for the short term, pardon me, but will have a better impact in the long term. And companies, you know, like banks, are so sensitive to this short-term risk. So it's really hard to get them to step out. I would suggest taking a look at a couple of organizations. One that you probably know, HomeWise. They've figured out a way to underwrite risk effectively for people that are traditionally left out of the financial system. And their model works really well. And I think that could be scaled up. Now, that's not for energy stuff, but they do home energy audit kind of like stuff. And then the other bank, and just full disclosure, Avalon Trust invests in HomeWise, and we invest in this other bank that I'm about to mention called Amalgamated Bank. And that's a bank that has written into its corporate documents that it's not funding fossil fuels, that they are funding efforts for community economic development. And yet it's a large bank. I mean, large relative to HomeWise. It's a tiny bank, you know, nationally, but so there are some good organizations that finance projects like that.
Okay, thank you, Melanie. So we're going to do a hard stop on questions right now. If you have any other questions, please post them in the chat or wait until after our next presentation. So next up is Drew Tolchin. And Drew is very active with New Mexico startups, most notably with Meow Wolf, serving as their first CFO. His efforts were led to raising more than $125 million in investment and employment growth from 50 to more than 400 employees. He has also worked with Build with Robots and Electric Playhouse. Consulting has taken him from across New Mexico to more than 40 countries. He has contributed to over 100 business plans and helped dozens of startups. His work has generated over $300 million in investment and over 1,000 jobs. Drew values community engagement. He serves on the board of WEST. He's a member of the Serve New Mexico Commission and advisor to the Pueblo of Acoma Business Enterprises. He is a member of the Social Ventures Circle and lifetime member of Net Impact. Drew completed his MBA from the University of Washington in Seattle. He finished his BA cum laude in History and International Relations from Washington University in St. Louis. So without further ado, let's go back to game show. And Drew, you're up.
Thanks, Andrea. Thanks very much. Thanks to our fellow panelist, Melanie. Want to thank all of you for taking your time to share with us today, both in this session and the day. Given the time, I think what I want to do is just share a couple of definitions and concepts, and then get back to the conversation, because we're starting to see some good questions in both the chat and with the hand raised. So I want to appreciate people who are fearless enough to step forward that way. And then I also want to put our facilitator, Andrea, on the spot, because she also does some really important work in New Mexico that deserves recognition, that I think is impact investing as a good example. So I am the new president of the New Mexico Angels. So what is angel investing? Angel investing is an accredited status. So there's actually a definition of what makes somebody an angel. And without boring you with SEC stuff, it basically means somebody who has enough money that they can lose some, right? And so this was done as a way to set up a way so that people who had enough money that they could lose it or waste it or be foolish with it, or hopefully make a great investment for the next unicorn or the next Uber or the next electric playhouse or the next Meow Wolf, had a way of doing that. And so there are different rules for people who are accredited and people who aren't. But with crowdfunding, I believe that that gap is now closing. And so I think what I really wanted to share with impact investing and get us to conversate about is that what if you could take whatever money you had. I read that some people are taking their $1,400 from the federal government in our relief, and they're putting that in investments. What if you could take whatever money you had, a couple pennies a day, just like Robin Hood, you had $1,000 checks, that we did that, and you put that towards something that you thought really mattered, really fit your values, your lifestyle, things you cared about, your neighborhood. What would that look like? That to me is impact investing. And we do have ways to measure that, but I'm less worried about how we measure it and more worried that we're not doing it enough. And so in my world, which is not the opposite of Melanie's, but separate from Melanie's, Melanie is in the formal markets, I'm in the informal markets. And what are the ways that you can get involved in that? So there's crowdfunding. HomeWise was mentioned. There's a whole body of entities called CDFIs, which means a community development financial institution, basically a lender for good. There are credit unions, so putting your money in a credit union. And now there's really a bunch of investments where even those of us with the more modest means, more the crowdfunding level, say $1,000, can get involved and lend or invest in opportunities, both small businesses, which is where I care about for New Mexico, but also funds or lending entities. So there's an entity here in New Mexico that used to be called Accion, and it's now called DreamSpring. They lend microcredit, they lend small loans to businesses. And there's things that can be done here in our community. There's things that can be done nationally in the United States, and there's things that can be done internationally. So let's see here. Last for definitions is for you to think about what is important to you and your own impact. Do you want to see jobs in Cuesta with a company like Taos Bakes, which is a local energy bar maker and snack maker? Do you want to see new health sciences with a local fund called Tramway Ventures or an entity called NM Bio? Do you want to see some energy organizations that Andrea can share about, like Osasda Energy? So what's important to you? And for you to be able to follow or seek those options and then find the tool or mechanism that allows us to do that. And my theory personally is that the more we all work as a village to raise the proverbial child, the more we can have the Meow Wolves of the world not be the story, but simply be this year's story. And each year we can have a new company come on the scene. So Electric Playhouse, for example, in Albuquerque, it was only open for a little minute, but they're going to reopen soon. And they're going to expand into Texas to help some of the strip malls there that are just shocked and closing. We have Built with Robots, which is a bunch of engineers here in New Mexico that were creating a paint bot, but then pivoted with COVID and have a disinfecting bot. If you've gone to the airport lately or would like to, every night you have these R2-D2 things that are spraying a disinfectant to keep things safe. And their testing with Sandia has said that right afterwards, the air is so clean that you won't even get any allergies. So if you're suffering from juniper like I am, go to the airport at midnight and get yourself safe there. Okay, so I think with that, I'll stop. Let's see, Andrea, let's see if there's a question or two from the chat, because I'm having trouble looking at it while I talk. And then I want to give Andrea a little bit of a spotlight and a shout out. And then I'm going to put our Dr. Riley White on the pedestal for a moment too, because he sees a lot of this stuff too. Okay, Andrea, how about a question or two, and then why don't you give it a go?
Okay, so I don't see a whole lot of questions in the chat right now. So let me open it up to anybody who hasn't posted anything and might have a follow-up question for Drew.
I did see one thing that I thought was interesting about short-term and long-term, and then someone else mentioned kind of how you measure stuff. And you know, my extrapolation, again, I'm not reading it because I'm trying to focus on the screen here, but my extrapolation is that one of our challenges, both in the formal and the informal markets, is the financiers and the entrepreneurs that are looking at our short and medium-term results, and they're not investing for the future, right? You know, our Native American sayings talk about 7 generations, right? And there's even a company that provides products looking at 7 generations. And the idea that is, you don't make a decision without thinking about 7 generations before, looking ahead and looking backwards, and what the implications of those decision making are. And I believe, as I think many on this call would, that a long-term decision actually produces a better ROI, a better return on investment. And maybe it doesn't right away. Maybe it doesn't if you include all of the social costs, the environmental costs. But if you do a full costing, then I believe a good decision for the long term is always going to provide a better yield. And the entrepreneurs who are directing capital sources to join with them to do that are going to be successful in the long term. They just might have to fight some of the noise in the short term. Andrea?
Okay, we've got one from Abby. So many investors focus on short-term profits. Do we think that impact of ESG metrics, more knowledge of sustainability will be large enough for everyday investors and company investors to assign value in a completely different way?
Yeah, Melanie, does that one hit for you?
I'm thinking.
Yeah. Well, let me start with a couple things, and then Melanie will jump in. You know, we seem to have some data-driven folks here, which I love because I also share that passion. And one of the things that I engage with some of our startup companies that are a little earlier in their journey, right, is you get what you measure. So if you set out to measure certain things for your own company, and if you're a B Corp, right, or a certified B Corp or a public benefit corporation, you have to, then your company will pay attention to that. And also then you can share that news in media and in general reporting. So for example, if it's jobs or sustainability or the diversity of your workforce or the diversity of your board, those are really easy things to know the answer to that you can specifically look at. You can give people a concrete answer, and then you can also do a delta over time, meaning the change of what's changed over time.
I would just add to that, Drew. I think you touched on something that's important, and that it's taking the data and using it effectively for storytelling. And that's not to say making stuff up that suits your particular short-term goal, but communicating the importance of these sustainability topics in a way that's appropriate for your audience. And I think distilling the key issue, distilling from the big wide world, the key issues that are relevant for your organization, your stakeholders, and really telling a compelling story, I think is often missing. And when it's done well, the general public seems, in my experience, to be more receptive to ideas around sustainability and ESG.
Those are really great answers. Thank you. Go ahead, Drew. Were you going to say something else?
Well, I thought there's a good question about climate change and impact investing. And I think I'd be interested, Andrea, in your opinion about this, because you know a lot about energy companies, but there's not an absolute path, right? We're going to have to make progress towards what I hope are zero emissions, or at least carbon neutral. But given where the American society is and where the world is in terms of embracing capitalism and the utilization of carbon and other, we need to make a progression towards it. And I think the UN goals is a great way for anyone to build that into vernacular. I think some companies are doing a better job, even if their company isn't specifically focused on climate change. So for example, with COVID, have we reduced our travel? And can we actually measure our miles in cars that all of our employees are doing? And would we like to seek to do fewer of them? That might not be a mission focus for the company if they're producing like Electric Playhouse or Meow Wolf, but it is something that they could choose to do that would have a positive media element, the story that Melanie brought up, and would also be possibly attractive to many of its customers. So it's worth doing. And then you have other really cool, innovative products that are doing better for the earth. And for those of us to march with our feet, even if we can't write an investment check, and to make a decision with our pocketbooks and buy things either at the co-op instead of just at Smith's, or if you're at Smith's, to choose something that has a more green label to it.
So with that, Drew, I think I'll lead into what you were asking me to talk about. So at the New Mexico Startup Factory, like I said in my introduction, we invest and create companies, and that in itself is impact investing. So one really great example that kind of ties into this whole conversation is Osasda Energy. So what Osasda Energy has done, it's a technology that we licensed from the University of New Mexico. We started the company back in 2017. And back then it was just an idea with a little bit of evidence in a lab. And what we've done is we've created 7 jobs within New Mexico. We have secured over $3 million in non-diluted funding, meaning we went after grant opportunities and successfully achieved them. And we have helped build the company up to a status to where we're ready to move to the next level. We do have some equity investment from angels and from our own portfolio fund. And what the company is focused on is they have created a new paste for solar panels. And what this paste does is it integrates carbon fiber nanotubes and bridges the cracks in these solar panels to create more efficiency and extend the term of the power. We are talking to people all over the world about it. And over time, as we kept everything in New Mexico, we are bringing the rest of the world to us to help develop this product. So I think that's a good example of impact investing in the green world. And I think it aligns nicely with what Drew and Melanie are talking about right now.
Thanks, Andrea. I really appreciate that. And the one other point I think I wanted to make, right, 2 points, and then I'll turn it back to Melanie to close, and Andrea to keep facilitating. But one is, look, Andrea's got a full-time gig in impact investing industry, right? And so this isn't something that's beyond all of our reach. This is something that's in our community and available to us. New Mexico Angels is very passionate about helping startups that we're working with, and they often need a young professional or intern labor or people who can really help and think in new ways. New Mexico Angels, we have some internship opportunities. I'm going to share with Dr. White some postings, and we'll have them on our website by the beginning of next week. So if you have an interest in this and you can do social media, or you're a good thinker and organized and can do some analysis for us, those are things that we need to get you into this industry. And again, when I was coming up, it was an odd man's out when you actually get a job in impact investing or in ESG. But now I think it's really part of it. And as someone answered when they raised their hand, why isn't everyone doing that? And we hope that this is going to be continued to increase and be everywhere. So, we at New Mexico Angels very much desire to partner with others. We want to help our startups to grow so that they can get the capital they need, both from angel investing, from crowdfunding and other capital sources, and also from our more institutional levels, so our government, our banks, and others. And there is the collective effort for us all to move forward towards that. And so with that, I'll put myself on mute, Andrea, and let you and Melanie take it home.
Can I have an input, say something?
Yes, absolutely. Please do.
Sure. So Invest New Mexico, we've invested in a solar company in Los Lunas that does vertical collectors instead of horizontal collectors, which take up a lot less land. And but one of the things that some changes that have happened with P&M is that P&M was aggressively trying to build their own solar fields, and now are looking to purchase power and have the investment come in to build those fields, solar fields. And we're really excited about the vertical solar collectors. And it's an interesting thing about what has happened in the wind turbine fields because of the change in the the weather patterns and stuff. Our solar fields which were determined to be good places to build wind turbines, they're having to shut down their turbines down to about 60% now, not because there's not enough wind, but because there's too much wind. So these vertical solar collectors on the towers of the wind turbines help create that additional energy. So I think that the key to this being effective is us bringing manufacturing to New Mexico, so that we manufacture all those turbines or those vertical solar panels. But we lose a lot of we have investors that the state's invested in, and angel investors and all that the investment happens in New Mexico, but they come to the next level of financing and they can't find it here. And we end up losing that technology. We finance quite a few startups that end up going somewhere else, and we need to really look at how do we keep those technologies here, and how do we grow the manufacturing.
So we are coming up on time right now. Drew, do you want to answer that? And then we'll go back to the main session.
I need a little help recasting that as a question for me to answer. Can you help me with that, Andrea?
So he was saying that these companies that are developing things that are important to New Mexico are going elsewhere because they're not finding the funding.
That's not my experience. I'm sure it does happen. I'm sure people have had that happen to them. But my experience is that good companies in New Mexico that have products that really are valuable, with staff and entrepreneurs that know how to engage with our government, with our funding mechanisms and elsewhere, have a lot of opportunity for capital, and there's a lot of capital available. And Business First, Albuquerque Journal, and other stories have luckily been running a lot of great stories almost every week on a new company that's getting capital. So I look forward to being able to help more companies, and we being able to meet more companies that we can help, and happy to learn more about companies that are seeking capital.
And Mr. Cole, Mr. Knoll, if you'd like to continue the conversation after, my email's in the chat if you want to send me an email, and we can talk about it a little bit more. So we are 1 minute over our time. So thank you all for attending. I think this was very informative. And my information's in the chat. Melanie, is yours in the chat?
Will be right now.
I'll ask Melanie and Drew to just put their emails in the chat, and you can reach out to them or to me, or whatever we can do to provide resources to help you. That's what we're here for. That's the whole purpose. So thank you again. And if you'd like to leave the room, I believe we're about to break for lunch.
Did I do it right?
This is great. Good work. You know, we're optimistic. Our Dee Zhu here is today. We're so grateful to have her, but we also have, in addition, Kimberly Gregokio, and I'm hoping she can make it. I know she's traveling right now, and she said she would be able to make it on time. So we hopefully we'll be able to hear from her shortly. This is good. Welcome. Genevieve, I haven't seen Kim online yet. Do you know if she's if she's run into any troubles?
I will say I don't know, but I will check. I'll be back in a minute.
Oh no, thank you. No, it's okay. Thank you. And so what I'll do is once we'll wait a couple minutes here as we get more people online. I want to introduce you to our two fantastic panelists that we have today, and then we'll get going from there. And I want to encourage you, as part of the moderating role, I want to encourage you to ask questions while the panelist is speaking. You can put it in the chat window. I'll help collect those questions and then reference them back to the panelists as we proceed. So feel free to ask the question when you see it. I'll keep track of it on my end, and then we can take it from there. So this is very, very exciting. And this is the afternoon panel. And so philosophically speaking, when we designed this, we were trying to figure out, okay, how do we sort out the panels between this? In the morning session, we were thinking, this was this developing a sense of urgency, developing the background, the higher order view. And the afternoon session was for the application, which is particularly challenging. Now that we've established, okay, maybe this impact investing is something that we can do. How do we actually evaluate these metrics? How do we go down and what are the practical ways that we can evaluate and do things like ESG or impact investing in a way that is meaningful, in a way that is convincing and can be applied directly to your clientele or to you as investors themselves. So wait a couple more minutes, a minute or two here, and then I will do the introductions. And if not, our backup will be, it'll be the D show, but then we can have a long conversation about D. You can just go on forever. That's what you can do. Just keep talking. Okay, good.
Here.
All right, so. Well, let's see. Let's get started. I know everyone's time is valuable here. We are here to rock and roll. Here's some presentations and take it away from here. So let me do this. So I'm going to talk a little bit about, let me introduce both of our panelists. Hopefully Kim will be joining us shortly. But first we have Dee Zhu. And Dee Zhu is an investment principal at Cambiar Investors. Prior to joining Cambiar in 2021, Ms. Zhu worked at Thornburg Investment Management as a portfolio manager and global equity analyst for the International Equity Strategies and Better World ESG International Fund, which I believe was very high performing as well. But Dee began her career at Wilshire Associates as a senior associate. Then she received an MBA in analytic finance, accounting, and strategy from the University of Chicago Booth School of Business, and a BS in business administration from the University of Southern California. Dee, thank you so much. And Dee, although not listed in her biography, has also been for several years now the industry mentor for our research challenge team at UNM during the CFA Research Challenge. In addition, hopefully joining us shortly will be Kimberly Gregokio. Kimberly Gregokio has an MBA in sustainability and CEO of Horizon Sustainable Financial Services of Santa Fe, New Mexico. She is fiercely committed to helping investors achieve financial success while simultaneously pursuing positive environmental, social, and economic change consistent with her investors' values. She brings a socially engaged, people-oriented perspective to her work in the investment world. Her firm provides asset management to individuals, nonprofits, and small business managing accounts for other RIA firms' clients on a third-party asset management basis, providing ESG portfolios for firm clients while they manage client relationships, and we do the back-end work. She has a successful podcast titled Deep Impact Investing, available on the Horizons website, wherever you find your favorite podcast. And again, thank you so much. It's such an honor to have you here. My name is Riley White. I'm an associate professor of finance here at UNM. You've heard enough of me already. So without further ado, I will introduce Dee to start giving her presentation. And then if you have questions that you'd like answered, I'll keep track of them in the chat window, and then we'll bring them up afterwards, and we'll have a Q&A session with Dee. So thank you all.
Great. Hello, everyone. Nice to meet you. Hi. So I thought it's really a lot to talk about ESG investing. So maybe I thought maybe we can start where to talk about, ESG is no longer a niche investment style that's only suitable for the tree huggers or the equivalent of so. Right, so it's relevant to all investor types, and we all should care about it in different ways, right? I tend to like to use electric vehicle as an example to talk it through. So if we think about EVs, and ESG investors like me or other impact investors care about EV deeply because we care about from carbon emission perspective, right? So we know from the start manufacture process, the EVs actually emits a lot more carbon than internal combustion engine vehicles, right? But for mid-size EV, we probably will get carbon neutral around 20,000 mileage, right? And then everything above that, EVs are going to be emitting a lot less carbons. But the tricky part is, which is really cared by ESG investors like me and others, is how much cleaner EVs are. It's actually very much depend on the electricity generation mix in the country you drive, right? So for example, if you live in France, where your majority of your powers actually come from nuclear, and your EV is much cleaner than others, say us living in the US or Germany, where a lot of our power is still coming from fossil fuels, right? So, but if you think about from climate change perspective, right? So is EV adoption really the solution to that problem? Well, EV definitely helps, right? Because incrementally it reduces the carbon emission. But what's really the problem is that 90 million new cars we produce and sold every year, right? So, the better solution for transportation carbon emissions is actually to promote, mass transit, right? So buying less cars. And that's sort of what I tell my husband when he wants the new cars. I know, drive that old car. It's better for the environment. But in that scenario, right? So the non-ESG investor should also care very much about EV adoption curve, right? Why? Because if you imagine in the scenario 2040, where in Europe at least would not produce any more internal combustion engine cars, right? So what does that mean to your investment in your automotive OEMs, or say its supply chain, or your gas station infrastructure, or even energy consumptions, right? It has a lot of implication of your investment in related area. And more importantly, people kind of don't talk very much about it, is what's EV's impact to your power generation and distribution. The impact is profound, right? So because if we think about what is EV, EV is nothing but giant battery sitting in your garage, right? So what you can do with that battery is you can charge it during nighttime, during trough hours, which you pay almost zero money for your electricity. And you can use that to power your house during peak hours, right? So what you're doing is you're effectively load shifting using your EVs in your house, right? And what does that mean? Is you're basically disrupted your energy provider's revenue model, right? So where they're making all the money from peak hours and not making money from trough hours. And also, if you have, if we happen to live in a place that has two-way power grid, you can actually sell your power back to the grid at a premium, right? So again, the implication to the grid, to power generator, to your local distributors is very much profound. And then that's why ESG investors or non-ESG investors need to or should care about ESG trends like EVs, right? Another point is why sort of non-ESG investors are caring more and more about ESG trends is consumer behavior is changing, right? So if we think about consumers are willing to pay more for plant-based proteins, right? So this is your Impossible Burger and whatnot. So that's when people learn about this feed to meat ratio, right? So for chicken, it takes 2 units of feed or grain to generate 1 unit of chicken meat. And for pork, that ratio is 3. So 3 parts of grain feed to generate 1 part of pork. For beef, that ratio is 6, right? It's horrendous to think about how inefficient that is, right? And so consumers are willing to pay more and switch to plant-based protein, not because it's lower calorie, because it's not. Don't think it's lower calorie, but it's really the inefficiencies for us to generate animal proteins, right? And then from that perspective, brands are very keenly aware of this change in consumer behaviors, right? So, Unilever and Danone in Europe, European consumer space are very much sort of in the forefront, really thinking about what is their brand purpose, in terms of ESG, what does that mean to your consumers? I remember maybe 2 years ago, I was at a conference and listening to Hormel, so the maker of Spam. So they were also talking about brand purpose, right? So, and really talk about, what's the meaning behind Spam? Like, I was like, man, that's pretty good. I really want to go buy a can of Spam, right? So which probably hasn't been part of my diet since, whatever the last Hawaiian trip I took, right? So, but this is what the brand owners are thinking about, to responding to consumer, behavior changes and whatnot, right? So let me talk a little bit about as an ESG investor or impact investor, what we're really trying to achieve, right? So there's 2 things we're trying to achieve. 1 is impact, and 2 is return. And by return, I mean excess alpha or reduction in risk, right? So it works both ways. And the key challenges today for ESG investors is really measurement and disclosure of the related areas, right? Without those data, we can compare companies cross sector, cross geography, and which means the company equity investor cannot lower cost of equity for those companies, and banks cannot lower cost of debt for those companies, right? And then corporate management, exactly, they don't even have incentive to invest in ESG related issues if you can measure it and reward them accordingly, right? So, we need consistent reporting on comparable data on material factors, right? So we need consistency, comparability, and material. So, Europe has pretty much always been leading the initiative, and then EU taxonomy is another way or a new way to think about it. There's, clearly plus and minuses, but that's a 1 step toward, reporting the, consistent data for people like us to be able to use it. But, I guess all in all, I think even with all those challenges, ESG investing is here to stay. It will become a table stake for all investors, whether you're ESG focused investors or just the non-ESG investors alike. So I'm going to stop here and pass it on to Kim, I guess.
Thank you so much, Dee. That was amazing. I appreciate your conversation. And now Kim, I introduced you before you stepped in, and I read your biography, so people know of your awesomeness and what you're about. And I encourage, at the same time, Dee and Kim to put their contact information towards the end of the program if they would like any follow-ups, as well as Kim, of course, with a fantastic podcast. One of the things that I want to reiterate, I have a couple questions that people have sent me directly for Dee. I'll report them at the end after Kim finishes her discussion. So Kim, take it away when you're ready, and thank you so much, Dee.
Great. Thanks so much for having me. Sorry, I had a little technical problem with the computer, so I'm on my iPad now. Great, so I'm going to talk about taxonomy and the application of ESG in investing. I'm going to start a little bit here, and since you already did my bio, I won't really introduce myself. We'll just jump right in. I want to just talk about a little bit about taxonomy and definitions in the ESG world, and really about the non-definitions in the ESG world, because that's kind of where we're starting. And in terms of what we really need to do and focus on, and the difficulty in terms of creating definitions of the E, the S, the G in this industry. And what are the important elements, who gets to decide what those definitions are, and whether we should have universal definitions in terms of the products that we're using and the ES and G, and what those definitions are. Who's going to decide that, whether it should be countrywide, whether it should be firm-wide, whether it should be client-based definitions. We know that the EU has been working on some definitions in terms of creating their sustainable finance plan as part of the bigger European Green Deal. They're probably farther ahead than a lot of places in terms of creating definitions. They have a classification system, but it's not fully vetted out really in terms of a full definition in this process. Canada, our neighbors to the north, have been focusing on a green finance sector in their economy as well. And they have a multi-point plan that they've been working on, and they still don't have definitions of E, S, and G, or any of the other pieces to this pie. Australia, interestingly enough, has a 37-point recommendation plan as part of their sustainable finance initiative. And it's segregated into three parts: their short-term plan, their mid-term plan, and their long-term plan. Their mid-term plan, which they hope to have fleshed out by 2025, does have a taxonomy project in it in terms of creating their sustainable definitions. So that's kind of exciting, and we'll see what they come up with in 4 years, if they can create some definitions. Probably, I think, actually the most forward thinking in this process is the IIF, or the International Institute of Finance, which is a group of 50 members, 20 countries involved in this. And they have a proposed classification system where they want to simplify these definitions. And it's a group of institutions and fund managers around the world who are trying to create a set of definitions. So I don't know, we'll see where that goes. We know in the last several years, we have a lot of bigger institutions in the US, our fund managers, the US CIF, all are looking at trying to create definitions in this process because there really is no universal definition. Where we're at right now is a couple of minor definitions that we have in a universal process in this, and that's inclusionary exclusions, or inclusionary process, exclusionary investments, and impact, which can be still a variety of definitions, but when we talk about exclusionary investment process, we're really talking about actively avoiding certain investments in the investment process, whether it's corporations, country exclusionaries based on certain screens and criteria. And then of course the inclusionary investments where we are actively including corporations or countries based on certain screens again, or underlying data that has been vetted out in a particular process. But then again, who is determining that screening process, which is a bigger question. I'm going to talk about that a little bit more later. The definition for impact, I think, is always problematic. We do have somewhat of a definition, and that's investments that are really seeking for having a direct positive impact, a measurable impact on society and the environment, or a social impact or a government impact. It's a measurable impact while targeting generally market rate returns. But we also have a lot of investments that target below market rate returns that we consider high social impact investments. So I think this is a problematic definition as well. So there needs to be probably several layers of definition on that process. Other terms that we really have to find definitions for are the E, the S, and the G, because I think that varies. For me, what I see is a definition that varies amongst clients. And I think we see that in institutions, we see that in fund managers, we see that from a variety of places where there's just a bunch of definitions. Then there's the definition of sustainable. What's sustainable to me is going to be different definition than what's sustainable to you. There's a lot of various definitions that we could list out. Every one of us probably has something different that we think needs to be defined. Shareholder advocacy is pretty well defined, but it probably needs to be fine-tuned in terms of what we all think that definition should be. Talking about application of all of these different factors, I'm going to talk about how we as a business apply a lot of these different components to it. And it's really beyond just the financial piece, as we all probably have some sense or idea of. And it's about a personal application in terms of sustainability, in terms of process. And again, when we're looking at the ES and G, when we're looking at impact, it's very personal to every single client that we work with. So we use a social policy questionnaire because what's impactful to me, what's sustainable to me is not the same for you or for every client. So we really try to pull out those pieces to find out what works for each individual client. Of course, you have to look at the financial pieces as well, but we're really trying to tailor investments on that social level. Because again, there's no simple definition to environmental, to social. Governance is a little easier, but it might be slightly different for everyone what they want to focus on. So as an advisor, it's really up to us to really know and understand how to be able to find the research on mutual funds, on stocks, even on bonds, on those corporations or the municipalities, on what they're doing in that underlying social, environmental governance areas so that we can really tailor portfolios to our clients. There are actually a lot of places where we can gather that information now. It's a lot easier than it was 23 years ago when I started in this business. So we have to really do a deep dive in terms of applying all of the social criteria for clients. Because again, their definitions are going to be different than mine. It's going to be different than the next person. It's really not enough just to pick the funds anymore and say, hey, this one's going to work for everybody, because it really doesn't. There are hundreds of mutual funds now out there that claim a SRI criteria. And now they can just claim that if they have one screen, whether they screen something out or they're positively screening something in. And so we really want to do a deeper dive than that in terms of looking at mutual funds. Stocks I find easier in terms of screening in or out, negative or positive screens. Some areas are a little more difficult when you're looking specifically at mutual funds. For example, emerging markets. Those have always been a difficult area to include in client portfolios. It's getting better than it was even 5 years ago. International bonds are also a little thin in terms of social screening, adding to portfolios. High impact investments. That is an area that's always problematic unless you're a high net worth investor. What I'm finding is that it's starting to open up to our clients who are smaller investors, and I'm thrilled about that. But again, what is that high impact for each client? Some people really want that. Well, I would say a lot of clients want what we call that sexy investment, which is the high impact, those high impact investments that really do this deep dive, very important work. But it's been so difficult for a long time unless you had $1 million or more. But we have all of these clients who come in and maybe they only have $100,000 and they really want to do this very important work. And trying to find those investments have been difficult for those folks for a long time, but it's starting to get a little bit easier. So really what we're looking at is trying to find these broad definitions. And I know the US Social Investment Forum, USIF, I'm assuming Riley mentioned that I am on the board, just for clarification, of USIF. We are trying to look at how to contribute to definitions of all of these different components. But it's difficult because everyone's going to have a little bit of a different bent to all of those pieces. But having some sort of universal definition will be helpful for fund managers, for individual stock managers, even for the bond managers. And it's something that really needs to be clarified out there. And in terms of applying that over the course of whether I'm doing investing or a institutional investor. And especially, I didn't read the chat yet, but I saw someone pop up with something about public funds. Very important for managing public funds and institutional money. So that's what I have to say there. So we can pass it back to Riley and do questions, I think.
Fantastic. Thanks to Kim and Dee so far. I've written down the questions here. We'll go over them in order, but a round of applause for both of our fantastic panelists. Thank you so much for getting up here and spending time with us today. And I know it sounds like a single clap in the wilderness, but everyone is clapping.
I see.
But, I know. So we have this. So the first, we're going to go back, and for the first question is for Dee. The second is for Kim, and we're going to go down. And the next questions are for both of you. So it worked out very neatly. So the first question for Dee comes from Sunny Gokhale, and it asks: does the focus on ESG metrics for companies take away from a return on investment focus?
So the short answer is, if we can measure it, we shouldn't, right? So the problem right now, we have this conflict of how do we measure ESG related investment? And what's the impact of it? Can we reward company for doing those investment, right? In what form can we reward those company? So can we lower the cost of equity for those company, or banks could be able to lower the cost of debt for those company, right? And then also incentive, right? So management, there's a lot of company management talk, a big game about ESG and how is that being focused and whatnot. But you all know, if you're a very disciplined company and very focused on returns and you're very much market driven, unless there's a way to measure your investment and therefore, hey, I get credit for making those investment actually has a financial impact or benefit to the company's bottom line, it's not going to get impacted, right? Or implemented. So again, I don't think it should be mutually exclusive, but we have to get a better way of how can we measure in and credit company for doing those things. I don't know if Kim has anything to add.
Yes, I want to add just a little bit to that in terms of when we do shareholder advocacy with a number of companies, we often have to show them that there is a financial benefit to making change to a number of business practices that we're asking them to make, whether it's avoiding lawsuits down the road or this business practice will save them money. It's a business proposition for many companies. There's that piece to it. And when we look at the general picture of screening client portfolios over the long term, we can show them or anyone a benchmark that mirrors the S&P 500, has a ridiculous name. It used to be the Domini Social Index, which was so easy to just say, but now it's the MSCI KLD Social 400 Index or something close to that, which has over a 30-year track record. Abigail is making a funny face. That's a ridiculous name, right? It's been bought several times, and so everybody adds their initials to it, right? But the track record of over 30 years shows this benchmark of 400 screened stocks mirroring the S&P ever so slightly outperforms the S&P 500. Barely outperforms. So we're not going to claim that it's going to outperform a broad US market index, but we're going to say it's going to perform about the same. So if you make good choices in your investments, we're going to say social investing does not underperform, which is what we want.
Awesome follow-up, awesome answers from both of you to this question. The next question comes from Abigail Hannock to everyone. As far as excluding countries, could we prevent that measurement from falling into political biases?
That's a tough question. I think it often does fall into political bias, and it probably should, because you're often looking at human rights violations, and those are very political when we're looking at the social piece to it. You're not going to have that in every single country. And when you are looking at the human rights violations, those are very political. So it's probably a given on that component.
I'm going to say something maybe controversial, right? So if we think about in the retail space, sweatshops, or that's one very hot area to talk about. So if you're a brand owner, you can say, hey, we're going to exclude certain countries, Bangladesh or whatnot, because they don't meet our standard of paying living wage to their worker, right? But you really think about the implication of that, right? So, the people works in textile industry in Bangladesh, the wage they're paying is probably much better than the alternatives. And two is, when you do exclude those countries, what you're really doing is, in a way, protecting your textile industry in Europe and US, right? So you're not really helping the workers in Bangladesh to improve their livelihood, right? So, again, I agree. You can get away from those political biases, but there's a lot of nuances we need to think about.
Well stated. Thank you for considering that question. The next question, comes from Tom Corbett. I'm wondering if there has been much work in mathematical modeling to help evaluate the risks and benefits of ESG investing. I'm thinking, for example, the business dynamics approaches promoted by the Sloan School at MIT. And I guess, are either of you aware of any of the math side of ESG investing?
I don't know of any particular studies, but I'm guessing there probably are. but I couldn't say any off the top of my head for sure.
Tom, I think you've stumbled on something novel. This is good, Tom. I think you've developed an investment niche.
Why don't you create one, Tom?
That's great. We have a question from Steffi Weisberg. She says, for public institutional investors, is there a metric for the social cost of investments that the public sector would have to be responsible for down the road?
That's an interesting question. So if I understand your question, for public investments, and Steffi, are you asking about like municipal type investments? You can nod, yeah.
Well, I'm not going to hide it. For example, the UNM endowment, if they invest in oil stocks and that contributes to water shortages, health disparities, that the university itself is going to have to pay in the future for more energy costs and health for their employees and et cetera.
Yes. Okay. That makes total sense. I would say, yes, that is certainly a factor. It's very much like a hospital, which UNM, for example, has a huge hospital, owning tobacco stocks in their retirement portfolio. Why would, and they probably do, why would they own those when they're actively treating cancer patients who have lung cancer from smoking cigarettes for decades? So why would the nurses and doctors then own tobacco stocks in their portfolio? To provide themselves with continued patients? No, that doesn't make sense, right? And yes, it's a similar thing for owning oil and gas stocks, because you're just going to have to pay more for your energy in the future. Or schools and universities, again, owning gun stocks, when we've seen many, many universities and schools have mass shootings, and then they continue to own gun stocks in their portfolios. It doesn't make a lot of sense. So we've seen a number of schools look at, and pension funds for schools and universities, look at excluding those stocks from their portfolios as a matter of principle. Does that answer your question somewhat? I think it's a very nuanced question, and there's a lot of details that we could debate over.
But there's no metric, like the movement to put a social price on carbon now might be used in the model to say, to an investor that, the price of this stock, really has a cost to it as well.
A social cost?
Yeah.
Yes. It's difficult to always put a social cost. How do you put a social cost on the life of a child who was killed at 5? Because you don't know what that child's life is going to eventually earn. So it's difficult to say that. I will say, our firm, Horizons, contributed a lot of work to the para plan, or working with the folks who were fighting against the para plan here, or the Santa Fe Teachers Union, to divest from prison stocks. And we actually did the cost analysis of why it didn't make sense to continue owning those stocks. They kept saying, well, it's too expensive to get rid of them, and it's hard. What would we replace them with? And we looked at their entire portfolio. It was just a fraction of their multi-million-dollar portfolio. And the fact is, over the 10 years that they'd held those stocks, they'd lost a significant amount of value. in the portfolio. And it didn't make sense for them to continue holding them because they were just dropping and dropping in value over the time that they'd had them. They were a significant loss to them. And we kept presenting them with that information. And in terms of selling them and taking them out of the portfolio, it was much more cost effective to actually do that. And so we presented that particular piece. And then again, how do you put the social cost on those private prison stocks when they're holding immigrants in the detention centers, which was the reason why the Santa Fe teachers wanted to divest from that, because so many of their students had family and parents in those detention centers. It's very difficult to put a social cost on that.
Well, thank you so much for the answer as well. And this is one from Genevieve Chavez Mitchell, my co-organizer of this event. She asks, this is for both speakers, what recommendations do you have for local investing?
I'll let you go, Dan.
Oh, for local investors. So I think, first of all, ESG investing there used to be a myth that you have to give up return. So I think, my 5 years managing an ESG fund, you always have to start with that. Say, hey, ESG, by investing in ESG, you do not have to give up returns. And more importantly, we think ESG analysis will help us to be even better investor and better analyst in looking at companies. And this is both coming from excess return generation and also reduction in risk, right? So I think that's one key area that we have to think about. Hey, this is no longer a niche investment that we put a little bit in our portfolio that we feel good about it. We can actually this is going to be a much more mainstream product, right? So, again, for every, the other thing is, I think for an investor to really think about is we're still kind of in the beginning of, in terms of disclosure metrics and whatnot, right? So think about the accounting standards and how long did it take to develop and to today. And then, today we can argue about, oh, I care about ROIC, you care about margin, but without the sort of the three statements, we can't even get there, right? So the more engagement we have with companies on, ESG related issues, both including actions they're taking, but also disclosures they have on their, their company, is going to be very, very much beneficial to, all of our sort of investors alike.
Thanks for asking the question. I would say local investing in terms of impact in our communities is, again, as I mentioned, one of the harder pieces to find for clients. We have a number of things for our high net worth clients that we can help them with. There's a couple of things that are what I would say lower net worth investors can participate in. We do some community investment notes, which our clients can localize regionally, and those have investments in, a number of those are in specifically New Mexico, but they're getting a regional investment in. They look very much like a CD. They are 1 year investments, 2 years, 3 years, 5 years. We also have clients who have invested in things like HomeWise, if you're probably familiar with that. We're always looking for things that filter through our due diligence process that our clients who are below $1 million can participate in. And a lot of them don't quite meet our due diligence standards. So it's hard because if we feel like it's not a good, safe investment for our clients, we won't put them in it. We have a number of clients who will do them on their own, and that's fine. If they feel comfortable with it on their own, they will go ahead and do that. If we don't feel comfortable with it, we won't put it through our firm. Because if I don't feel comfortable with the liability, we won't do it. But there's some great possibilities in New Mexico, and we've always looked for investments in the indigenous lands here. It's very difficult to find things that we can put our clients into. Farming would be great if we could find something that worked for our clients, especially in sustainable agriculture. I would love to see more options for that in New Mexico, but it's hard. I mean, New Mexico is just not a very populous state. And so finding some of those things is more difficult than you would think. So.
Wonderful. And the questions are pouring in. We've got all kinds of things. This is great. We've got some others. We have another question from Steffi, then John, then Abby, and another private message question. They're just like, we're going to get through as much as we can before 2, but be conscious about the time. We're about 10 minutes left, and I want to appreciate our panelists' time as well. So first, Steffi asks, is there any hope for UNM and other state universities or any state universities in oil and gas states to divest from fossil fuels or even publicly invest in clean energy without being seen to alienate the oil and gas industry on which it might depend for state funding?
Well, I don't know why we have to worry about alienating them. I mean, and I think the governor is planning on making up the difference there by legalizing cannabis. That's her plan. So we'll see. I don't know. I don't know how much money that will generate in terms of making up the difference, but we'll see. So I don't know. I think as we've seen more and more universities and big institutions and nonprofits starting to divest from oil and gas and other hot button issues, other institutions like UNM will follow suit. It has to come from within, though. You have to have the professors and the students calling for that action. Someone from outside, like myself, can't be the one to ask for that process. It really has to come from within, which is what happened, with the Santa Fe teachers. They started that process. We kind of helped them with some data, but we didn't start that process. It came from within, and they pushed it for a long time, but they pushed it. So it comes from within, and it will happen if someone's in there, poking that bear long enough. That's how that process happens. But we've seen some very big institutions. CalPERS has divested from a lot of stocks, and that's a huge retirement plan. New York pension plan. If they can do it, UNM can do it.
So maybe I'll just add something that maybe a little bit controversy, but so I used to manage a low carbon fund. So I'm all kind of no gas, no extraction industries, but we have to understand that oil and gas industry does really poor job in polluting our environment, but there's also benefit of oil and gas, right? So the energy intensity of the gasoline is amazing, right? So it takes for pound 1 pound of gasoline, you need to have 35 pounds equivalent of battery to power your car, right? So it is amazing. It's benefiting, doing a lot of things to our economy. So yes, there's a lot of negative associated with that industry, but we still need it in the meantime, I guess.
It's true. We all probably drive a car or use electricity in our home, which is powered by coal a lot of the times.
Yep.
So thank you so much for both of your answers here. We have a question from John. Are you seeing any trend in using family gift trusts for making impact investments?
I'm not really clear on the question in terms of gifting to people, John, or?
No, I mean, wealthy families will set up these gift trusts that are charitable, essentially.
Oh, like a charitable trust?
Right, yeah.
Yes,
Yeah.
yeah. I don't know if it's a trend, but we certainly have a number of clients who gift into charitable gift accounts so that they can then, I mean, they can be invested just in any way they want, but then those are donated out. So it's not necessarily a trend, but we have a number of clients who do that. I don't see that ticking up in any way. But I mean, my clients have their accounts in sustainable funds or stocks, and then we often donate appreciated investments into those charitable fund accounts, so they don't have to realize the gain taxably, and then they can donate from that. Does that answer your question? I mean, I don't see it ticking up in terms of increase in them.
Yeah, I was looking at it more just not making contributions to nonprofits, but actually to invest in for-profit social entrepreneurs and then getting a return, you know, if the entrepreneur is successful.
Oh, yeah, I see. But I have not seen that as an increased proposition or, you know, personally. So.
We have, this might be the final question. We have a question from Alexandra Crespo, and she asks, what about the investments in tourism? How would you, or maybe basically, how would you measure or evaluate tourism investments under these principles?
Like transportation wise?
That's it. Yeah, that's an interesting question. Do you want to answer, Di, or first?
Yes, so I guess tourism. I guess that there's you know, transportation probably one component. So I think transportation is one of the biggest, probably the second or third largest carbon emitting industry, but that including both, you know, cars and trucks and air travels. Air travel is actually not as big as you think in terms of, you know, carbon emission, but nonetheless, it is an area that, you know, we're probably going to see innovations coming in to think about how to improve the jet fuels we currently have to make it less emitting. So, you know, I guess apart from transportation, so the other thing maybe is a consumption perspective, right? So like going back to, you know, this is not just tourist, but also kind of just the fast fashion, just retail sector, right? So there's a lot of issues with the retail sector with waste, whatnot, and also from organic material perspective, right? So we all know majority of fabrics came from, you know, oil derivatives, right? So they're synthetic materials and they don't decay. And in the US, I think 85% of apparels end up in landfills and they just don't decay, right? And then the problem, so if we think about the natural materials might be better. So think about cotton. Cotton use tons of water. So I think the number is like 10,000 to 20,000 liters of water for every kilogram of cotton you produce. And 1 kilogram of cotton is probably enough for a pair of jeans and a shirt, right? So that's a lot of water usage for 1 kilogram of cotton. So retail industry, there's many issues from, you know, sweatshops to, material to, recycling and water pollution to dye your jeans. So that's not, isolated to tourism, but more just about sort of fast fashion industry where we're kind of,
Yeah. And just quickly, I'll add, if you just look at the hotel industry and the waste products there, not just food for conferences, there's just a ton of waste with food, but the washing of linens, many hotels change those daily. If you ever get those little cards that say, put this on my bed if you don't want it changed, and people throw their towels on the floor and they get changed every day and washed every day. It's a lot of water, it's a lot of chemicals. So that is a problem. So I try to always look for hotels that are a little bit more environmentally friendly, that don't change your linens every day, that do have the recycle bins in the room and take advantage of those things. So hotels can be actually very environmentally unfriendly if you're not picking better hotels. We need to encourage them to be much better on that process.
That is wonderful. And I wish we had more time. We have, we've had questions that we can't get to and answer. And I encourage the people in this audience to reach out to our panelists individually. We are so grateful for having Kim Gregokio with us, as well as Di Zhu from Cambiar with us. You both were tremendous. You answered some incredibly difficult questions, and both of your perspectives were incredibly valuable with regards to having this conversation. And I'm so glad we were able to do it. So right now it's 2 o'clock. It is time. You have a 10-minute break before Hakeem Bellamy is giving a performance for us at 2:10. And I encourage you to attend if you can, but relax, enjoy it, go back to the main room, and we're so grateful to have had you. So thank you so much for coming today to this panel. And thank you both. One more round of applause for our two panelists, Dee and Kim. Thank you so much.
Thank you.
Thank you.